And if the period is more than 1 day and up to 14 days is called as notice money. And if it deals fund for 15 days to 1 year, then it is called as term money. So yesterday we have discussed about all these and who are the participants in money market also we have learned. And today we are going to learn about money market instruments. Okay, what are the money market instruments? So money market instruments, when we call memory, commercial bill, treasury bill. Then we have commercial paper, certificate of deposit, interbank participation certificate, intercorporate deposit, repo instrument, and CDLO. Okay. Repo rate, reverse repo rate, we'll also going to learn. Then now we'll learn about what is commercial bill. So a commercial bill is a short-term negotiable and self-liquidated instrument with low risk. The market for buying and selling of commercial bills of exchange is known as commercial bill. The working capital requirements of business firms are made by the bank through cash credit, overdraft, and purchases or discounting of commercial bills. So here, according to Indian Negotiable Instrument Act 1881, a bill of exchange is a written instrument containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. So it is drawn by the seller of goods, who is known as drawer, on the buyer of the goods, known as drawee, for the value of goods delivered by the seller. So the bill is called trade bill. When the trade bill are accepted by the commercial banks, they are known as commercial bills. So banks generally accept commercial bills which are discounted by the payee, and the balance amount after deducting the discount is credited to their account. So commercial bill is also is one of the negotiable instruments, and there are different types of commercial bill: demand bill, nuisance bill, documentary bill, clean bill, inland bill, foreign bill, export and import bill, accommodation bill, derivative uses, promissory notes. So all these comes under commercial bill. So here now commercial paper. So this instrument was introduced in 1990. It is a short-term money market instrument issued by eligible corporates in order to raise funds to meet their working capital requirements. So the main source of finance is used as an alternative to bank finance. Commercial paper is an unsecured promissory note which is issued at discount with a fixed maturity. So the companies prefer to raise funds through this instrument. Most of the companies prefer to raise their funds through this instrument when the interest rate on working capital is charged by the bank is higher than the rate of which funds can be raised through commercial paper. So the maturity period of these instruments should not be less than 30 days and not more than a year. The commercial paper maturity should not be less than 30 days and more than a year. So only the corporate having a fund-based working capital facility of rupees 4 crore or more from banks are eligible to issue commercial paper. So their maturity is 30 days, and only those corporates have a fund-based working capital facility of rupees 4 crore or more from banks are eligible to issue commercial paper. So individual banking companies, other corporate bodies registered or incorporated in India, and unincorporated bodies, non-resident Indians, NRIs and foreign institutional investors, etc., can invest in commercial paper. So the minimum amount be invested by a single investor, it should not be less than 5 lakhs. So if any institutions or any foreign investors or any individuals want to invest their money in commercial papers, the amount should not less than 5 lakhs. So, and again on the maturity of commercial paper, if the instrument which is held in physical form, the holder of the commercial papers present the investment for payment to the issuer through issuing and paying agent. If the commercial paper is held in the form of demat account, the holder of the instruments will have to get it redeemed through the depository and receive payment from the issuing and payment agent. So commercial papers are one kind of negotiable instrument, and most companies prefer to raise funds through this instrument when the interest rate on working capital is charged by banks is higher than the rate at which funds can be raised in commercial papers. So the maturity period of this instrument should not be less than 30 days and not more than a year. Only corporates having a fund-based working capital of above 4 crores are eligible to issue commercial papers. So any individuals or banking companies and other companies, NRIs, those who want to invest their money in commercial papers, that should not be less than 5. So on maturity, if the instrument is held in physical form, the holder of the commercial papers present the investment for payment to the issuer through the issuing paying agent. And if the commercial paper is held in demat form, again, the holder of the instrument have to get it redeemed to deposit and receive from the issuing and payment agent. And the next one is certificate of deposit. So this is about commercial paper instrument, and the next one is certificate of deposit. Okay, this one. Certificate of deposit. So what is certificate of deposit? Certificate of deposits are also one kind of instrument. Okay, and these certificate of deposits are unsecured, negotiable, and short-term instruments issued by the commercial bank and financial institutions in order to raise money. In order to raise the money, these certificate of deposit are unsecured, negotiable, short-term instruments issued by the commercial bank. So they were introduced in June 1989. Initially, when they were introduced, only the scheduled commercial banks, excluding RRBs and local area banks, were permitted to issue the certificate of deposit. So if you see the movie, the series on about Scam 1990, in that we will see about the certificate of deposit, where the hero approaches bank for money, short-term money from bank. So they have discussed about certificate of deposit. So initially, only scheduled commercial banks, excluding regional rural banks and local area banks, was permitted to issue. Later in 1992, the RBI permitted financial institutions to issue certificate of deposit within the limit fixed by it. So before 1992, when it was started in 1989, only scheduled banks, except RRBs and local area banks, were permitted to issue certificate of deposit. But after in 1992, RBI permitted financial institutions to issue CDs, certificate of deposit, within the limit fixed by it. So there is no ceiling on the amount raised by the bank. Commercial deposits are subject to SCR and CRR requirements. Okay. These instruments are transferable and tradable. Commercial certificate of deposit can be issued to individuals, corporations, companies, trusts, associations, NRIs, and others. So here, 3 points to ponder is that it is also certificate of deposit also one kind of short-term instrument, okay, which is used by the commercial banks and financial institutions in order to raise money. These were introduced in 1989, and when these were introduced, first only scheduled commercial banks, including RRBs and local area banks, have given permission to issue. But after in later 1992, the RBI permitted all the financial institutions, they can issue certificate of deposit, and there is no ceiling on the amount raised by the bank. And the instruments can be transferable and tradable. Commercial certificate of deposit can be issued to individuals, corporations, companies, trusts, associations, NRIs, and others. So, on maturity, in case of physical form, the last holder has to present the certificate for the payment, and the banks also have to take necessary precautions and make payment only by a cross check, as these are transferable. So the holders of dematted CDs have to approach their respective depository participants and have to give transfer delivery instructions to transfer the securities to CD redemption account. So one should also instruct the place at which the payment should be made. So this is about certificate of deposit. And next we are moving to the interbank participation and certificate. So in interbank participation and certificate is also money market instrument. And in October 1988, the government of India, while dealing with credit policy measures, had informed the bank chiefs about a proposal to authorize banks to fund their short-term needs with the system through the issuance of interbank participation certificates. So here the Vogel Committee has recommended its revival in a modified form for evening out short-term liquidity within the banking system. The instruments are confined to scheduled commercial banks, but excluding regional rural banks. As per the RBI guidelines, there are two types of interbank participation that can be issued by banks on risk-sharing basis, without risk-sharing basis. So there are the two types of guidelines issued by the RBI where the interbank participation will take place. That can be issued by banks. One is on risk basis and another one is on without risk basis. So interbank participation with risk sharing can be issued for 91 to 180 days. So the interbank participation with risk sharing can be issued for 91 to 182 days, while without risk sharing, it has tenure of 90 days. So these instruments also benefit both the issuing and participating banks to have access to funds against advances with less cumbersome procedures. So it also facilitates the bank having surplus funds to earn over a certain period of time. Okay. So this is about interbank participation certificate. So here 3 points to ponder. One is in the year 1988, Government of India with credit policy measures had informed the bank chief about the proposal to authorize banks to fund their short-term needs with the system through the issuance of interbank participation certificate. Any short-term needs which are required by the government under credit policy, the Government of India has issued orders to issue short-term requirements of their needs through this instrument. So the Vogel Committee has also recommended its revival in a modified form for evening out short-term liquidity within the banking system. So here two types of interbank participation are there. One is on risk-sharing basis and another one is without risk-sharing basis. So the risk sharing basis period is about 91 to 180 days, 182 days, whereas without risk-bearing period is 90 days only. So here again, next instrument is intercorporate deposit. So intercorporate deposit is also another money market instrument for companies to invest their surplus funds with other companies. So how interbank participation certificate is there here also. It is also one of the instrument of money market. So intercorporate deposit means for the companies who are having surplus funds, they can invest their surplus funds in other companies. So it is an unsecured borrowing by corporate and financial institutions from other corporate entities registered under Companies Act 2013. So the companies which are having surplus funds would lend to another corporate which are in need of funds. Then Section 186 of Companies Act 2013 has come with the concept of loan and investment by the company. So the new act provides that intercorporate investments not be made through more than two layers of investment companies. Moreover, any amount received by a company from another company is not a deposit as per the provisions of company. Acceptance of deposit rule 2014, it may be loan and generally termed as intercorporate deposit. Yet they are not deposits under the Companies Act 2013. This market is not well organized and very little information is available for publicity about the transaction details. So intercorporate deposits are not organized. So and about their information is also very little information is available in the market. And the new 2013 Act provides that intercorporate investment not be made through more than two layers of investment company. Moreover, any amount received by a company from another company is not a deposit as per the provisions of Companies Act. So the next one is reverse repo instruments. So these are also instruments of companies, money market. So repurchase agreement is called repo. If it is a useful money market instrument that enables the smooth adjustment of short-term liquidity among the market participants, namely banks and financial institutions. Repo is a transaction in which a participant gets immediate funds by selling securities and at the same time agrees to repurchase the same securities after the specified period at a specified price. So it is also referred as ready forward transaction. So whatever the repurchase agreements are called as repos, it is useful money market instrument that enables the smooth adjustment of short-term liquidity among the market participants, namely banks and financial institutions. So repo is a transaction in which a participant gets immediate funds by selling securities and at the same time agrees to repurchase the same securities after the specified period at a specified price. Then it is also referred as ready forward transaction. So reverse repo is exactly opposite to repo. In reverse repo, the participant purchases the securities from another with a condition to sell them back to the latter at a specified time and price. So the difference in price between purchase and sale of securities is the profit to the lender. So here, these transactions can be done only the parties approved by the RBI and allowed only between RBI approved securities. So this is about reverse repo and repos. Okay. Repurchase of agreement is called repos. And reverse repo is exactly opposite to repo. So in reverse repo, the participant purchases securities from another, and the difference between purchase and sale of security is the profit. So next is CBLO, which means collateralized borrowing and lending obligations. Actually, it was introduced in January 2003 by Clearing Corporation of India Limited to provide liquidity to the non-banking institutions that are adversely affected due to restrictions on access to the call money market. It is discounted instrument which is available in electronic book entry form for maturities varying from 1 day to 90 days. As per RBI guidelines, the maturity period can go up to 1 year. So this CBLO, collateralized borrowing and lending obligation, by borrower to return the money borrowed at specified future date. So there is an authority to the lender to receive the money, lend at a specified future date, with the option to transfer the authority to another person for value received. So here, what happens is, it is a discounted instrument which is available in electronic book entry from the securities varying from 1 day to 90 days. Okay. So this CBLO is an obligation by the borrower to return the money borrowed at a specified future date. So the securities that are eligible to be dealt in this market are central government securities, including T-bills, with a maturity of more than 6 months. So in secondary market, there are no restrictions on the minimum denomination and lock-in period of the transaction. So the member of the CBLO are commercial banks, financial institutions, cooperative banks, insurance companies, primary dealers, and mutual funds. So the non-members are also allowed to participate by way of getting associated membership. So these are the different types of money market instruments. Now we will learn about what is foreign exchange and derivative market. So foreign exchange and derivative markets are also very important. Commodities markets also we have. So our next topic is foreign exchange market. Foreign exchange market are one of the most important financial markets in the world. Their role is utmost important in the system of international payments. The foreign exchange market plays a critical role in facilitating cross-border trade, investment, and financial transactions. So these markets allow firms making transactions in foreign currencies to convert the currencies of deposits they have to into the currencies or deposits they want. So they also help affect foreign remittances by accepting bill on behalf of customers. The foreign exchange markets are the original and oldest financial markets and remain the basis upon which the rest of the financial structure exists. The most basic function of forex market is to transfer purchasing powers across countries. So it is by far the largest financial market in the world, and it is comprised of the global network of financial centers that transact 24 by 7, closing only on the weekend. The concept of foreign exchange is they'll buy, they'll keep reserve the currency, and so the foreign exchange market or forex is the market where foreign currencies, foreign exchange is purchased and sold, either by over the counter or through currency exchanges. The foreign forex is a 24-hour decentralized market that works through various time time zones. So in foreign exchange, forex is called in short forex. So is a market where foreign currencies were uh, bought and sold, purchased and sold, and either by over the counter or through currency exchange. So there are many types of foreign exchange markets, and one is spot market, current method market, and second one is forward market. So the business organizations which are in need of foreign exchange also come under the retail category. And the total turnover in the retail market is relatively very small. And the retail market and the wholesale market is also termed as interbank market. So in retail market, we have traveled the tourist exchange, and similarly foreign exchange market could be spot markets and forward markets. So current or spot market for forex is the which manages only spot transactions or current transactions. The transactions are daily in nature. Spot rate of exchange exists in the time when transactions happen. Forward market is derivative market. So these markets are meant for delivery in future. The ascertain the foreign exchange rate is at which future hello. 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 So, meaning of foreign exchange is the term foreign exchange implies two things. One is foreign currency and exchange rate. So, foreign exchange generally refers to the foreign currency. For India, it is dollar, euro, and etc. And the other part of foreign exchange is exchange rate, which is the price of one currency in terms of the other currency. So this forex is the international market for the free trade of currencies. Traders places orders to buy one currency with another currency. So just now we have learned about how the foreign exchange will take place. Then the next one, this is the meaning of foreign exchange. According to Hurley, Witter's foreign exchange is the art and science of international monetary exchange. So the forex market is the world's largest financial market. Over US $4 trillion worth of currency are traded each day. The amount money traded in a week is bigger than the entire annual GDP of the United States. So the main currency which is used for the foreign exchange trading is US dollar. So it's all over the world. The main currency which is used for the trade as is US dollar. US dollar. So what are the features of foreign exchange? The foreign market is the world's largest market. Foreign exchange market is an over-the-counter market, which means there is no single market location, physical or electronic, or a centralized exchange like a stock exchange. So it operates round the clock, 24 by 7 at various time zones. The foreign exchange market area worldwide network of interbank traders comprises predominantly of banks which are sponsored by computers and telephone lines. A low trading cost, foreign exchange deals with a minimal fee towards commission. And one more feature is the foreign exchange markets are categorized by high volume of transactions. So there are different types of quotes in foreign exchange market. So a quote is the exchange rate at which an authorized dealer is ready to deal in a selected part of currency is called a quote. The exchange rate at which an authorized dealer is ready to deal in a selected pair of currencies is called a quote. The foreign exchange quotes indicate the number of these currencies. Units thus must be paid to obtain the quoted currency. And the base currency, rupee is the base currency here as it has a quoted first. And quote currency, it is the currency which is quoted as second. So base currency is quoted first and quote currency is quoted as second. Dollar is the quote currency in the above. So here Indian rupee is base currency. If we are exchanging with the dollar, that is called as quote currency. So there are one is direct quote. There are types of foreign exchange quotes are. One is direct quote. So a direct quote is an exchange rate which represents the democratic currency. In terms of single unit of foreign currency, the base currency is the domestic currency and the quote currency is the foreign currency. So whichever the country domestic currency, for example, our India is rupees. So rupees is base currency. And if you are exchanging with the dollar, it means it is a foreign currency. So the base currency is the domestic currency and the quote currency is the foreign currency. So direct quote is the number of home currency units per single unit of foreign currency. So the rate of direct quote is read as currency H in terms of F. So again, direct quote, an exchange rate in which foreign currency is expressed in terms of single unit of domestic currency. It is called as indirect quote. And the base currency is the foreign currency and the quote currency is the domestic currency. So here it indicates the number of foreign currency units that could be bought with the single unit of home currency. The indirect quote can be read as currency F in terms of H. Indirect currency is the reciprocal of the direct quote. So these are the types of currency. And what are the functions? Functions of foreign exchange market. First function is transfer of purchasing power and one currency to another. And the second function is international clearing function. The third function is provision of credit. It provides credit. And fourth is hedging facilities. So the most holding or offering covering of this in foreign trade. It helps in the funds transfer from one currency to another currency for settlement of payment. It also improves the conversion one currency to another, comprise the conversion of one currency to another, converting the currency from one to another. It transfers the purchasing power from one country to another. For example, if US exporter imports goods from India and the payment is to be made in rupees, then the conversion of the dollar to rupees will be enabled by the foreign exchange market. So they also help in clearing international clearing function. Foreign exchange market plays a very vital role in facilitating movement of capital and international trade. So they also provide provision of credit. So international trading relies on credit facilities to a very large degree. Hence, the credit role performed by foreign exchanges essential for foreign trade and development. Credit facilities are provided for both exports and importers. So the credit facilities with foreign exchange are provided by both exporters and importers. So to enable smooth flow of services and goods between countries, the importers and exports are provided short-term credit by forex market. Example, when an Indian computer who wants to purchase equipment from USA can pay for the purchase by issuing a bill of exchange in the foreign exchange market, necessarily with a 3-month maturity. So these intermediary helps will be carried out by foreign exchange of conversing the currency of one country with another country. They easy the function of trading from one country to another country. And they also enable smooth flow of services and goods between countries, the importers and exporters. Foreign exchange market is to offset the hedge foreign exchange risk. So hedging is a technique of offsetting or converting of risk in foreign trade. Hedging is quite beneficial and effective to importers and exporters as they can protect themselves against losses that can result from changes or fluctuations in exchange rate. Such hedging is done through the use of derivative contracts. So in foreign exchange main key role is to conversion of one country's currency with another country's currency. So foreign exchange market in which national currencies are traded for one another. So the major participants in these markets are commercial banks, forex brokers, and authorized dealers and the monetary authorities. Besides transfer of funds from one country to another, speculation is an important dimension of foreign exchange market. It's where money is in one currency is exchanged for another. So what are the terms related to foreign exchange? Foreign exchange reserves holding of other countries' currency. Foreign exchange controls imposed by governments on the purchase, sale of foreign currency. So retail foreign exchange platforms, speculative trading of foreign exchange by individuals using electronic trading platforms. And it also foreign exchange also have risk arises from the change in price of one currency against other currencies. Bureau the change a business whose customers exchange one currency for another. So there is also a facility of digital currency exchange. Market makers with exchange for currency for electronic money. So there are many instruments in foreign exchange market. Instrument in the spot market is none other than the currency itself. Instruments in derivative market for future exchange. And there is also foreign exchange forward, currency future, currency swap, currency options, currency ETF. So a forward currency exchange contract is a deal to exchange currencies to buy or sell a particular currency at an agreed date in the future at rate. So the price agreed now, this rate is called the forward rate. A buyer and seller agree on an exchange rate for any date in the future. And the transactions occurs on the date at the agreed price, regardless of what the market rates are then. So first, the buyer and the seller come together and they'll decide one future date. On that same date, the same rate, the foreign exchange will take place. So the duration of the trade can be 1 day, a few days, months, or years. Usually, the date is decided by both the parties. Here, the date is decided by both the parties. Then the forward contract is negotiated and agreed upon by the both parties. So what is currency future? Now we have learned about foreign exchange forward. Now currency futures. So a currency future is a foreign exchange future is a futures contract to exchange one currency for another currency at a specified date in the future at a future exchange rate. A future contract is similar to a forward contract with some exceptions. Then future contracts are traded or exchange markets where forward contracts typically trade and over the counter market, that is OTC. So here also future contracts are also settled on daily market to market basis, whereas forwards are settled only at expiry of that term. Okay. So here the most forward contracts have physical delivery. So far those held in the last trading day, actual payments are made in respective currencies. However, most contracts are closed on before that investors can close out the contract at any time prior to the contract delivery date. Investors enter into currency futures, contracts for hedging and speculation purpose. Then the currency swaps are over-the-counter derivatives. They are and are closely related in interest rate swaps. So a foreign currency swap is an exchange borrowing where the principal and the interest payments in one currency are exchanged for principal and interest payments in another currency. So mostly the corporate bodies with the long-term foreign ability enter into currency swaps to get cheaper debt and to hedge against exchange rate fluctuation. So the best example of swap is paying 60 rupees interest and receiving floating foreign currency interest. So here again currency option. Options are an agreement between a seller and a buyer which gives a buyer the right but not the obligation. So currency options are the agreement between a seller and buyer which gives buyer the right but not the obligation to purchase currencies of specific amount at a predetermined rate for a specified period of time. So regardless of the market or spot price of the currency, unlike future or forward, which confer obligations on both parties, an option contract confers a right on one party and obligation on the other. So the seller of the option grants the buyer of the option and the right to purchase from or sell to the seller a designated instrument at specified price within a specified period of time. If the option buyer exercises that right, the option seller is obligated. Again, the currency ETF. Among the forex instruments, we are also having exchange traded funds, ETFs, which are called as ETFs. So ETFs are open-ended investments like mutual funds companies that can be traded, replicating investment in the currency market. So the funds track the price movements of world currency. Currency exchange traded funds mainly derive their profits due to fluctuation of the exchange rate. They purchase the currency of different countries based on calculated predictions about the future performance of that currency. So the exchange traded funds follow not only the currency price movement, but they also follow the stock exchange trends, the political and economic scenario of the respective country. So who are the participants of foreign exchange? So there are so many participants in foreign exchange. So exchange rate. The exchange rate is the price of the currency of a country. Can be exchanged for the number of units of currency and other country. Exchange rate is that rate at which one unit of currency of a country can be exchanged for the number of units of currency of another country. So it is the price for which one country is exchanged for another rate. So what are the types of exchange rate? Types of exchange rate. Fixed exchange rate is the official rate set by the monetary authorities of the government for one or more currencies. Another one is under floating exchange rate. The value of the currency is decided by the authorities. Regulation and structure of foreign exchange rate. Now we are learning. So the foreign market in India operates under the central government. The government exercises specific powers to monitor foreign transactions under the Foreign Exchange Management Act 1999, that is called FEMA Act, Foreign Exchange Management Act. It is also called FEMA Act. And this act regulates the whole Indian foreign exchange market. Before this act was passed, the Indian foreign exchange market was regulated by RBI through the Department of Exchange Control under the Foreign Exchange Regulation Act or FERA 1947. So interbank foreign exchange trading is regulated by the Foreign Exchange Dealers Association of India, created in 1958. So this is a self-regulatory voluntary association of banks and our dealer who have specialized in the foreign exchange activities. It regulates the governing rules and determining the changes and the commission associated with the interbank foreign exchange business. Clearing and settlement in the Indian forex market have been largely promoted by Clearing Corporation of India Limited since 2001. So the CCIL, Clearing Corporation of India, handles transactions around 3.5 billion US dollars a day, around 80% of the total transactions. So the structure of foreign exchange market consists of the central bank, authorized dealers, market makers, money changers, franchisees, foreign exchange brokers, and clients. So central bank, a country's central bank regulates the foreign exchange market. It buys and sells foreign exchange with a view to stabilizing exchange rates and maintaining them within the orderly range. An authorized dealer, AD, it is an entity, usually a bank that is authorized by the central bank under Section 10 of the Foreign. So category 1 banks known as commercial banks, private banks, and public sector banks and foreign banks. And under category 2, regional rural banks and cooperative banks will cover. To select financial institutions like Exim Bank belong to category 3 of EDs. The foreign exchange in India is also the Foreign Exchange Association Dealer of India is also an association formed by authorized dealers in 1958, and they seek to ensure the smooth functioning of the Indian foreign exchange market. So these authorized dealers, along with the central bank, help in smooth functioning of the Indian foreign exchange market. So authorized money change is a body corporate licensed by the RBI to deal in foreign exchange. So a full-fledged money changer is authorized to purchase foreign exchange from residents and non-residents visiting India and to sell foreign exchange for certain approval purposes. So prior to 2007, the RBI permitted restricted money changes, but they have since been replaced by franchises. So these restricted money changers are no longer permitted to operate in the Indian foreign exchange market. So here again, a franchisee is also known as agency, which is appointed by authorized dealers either under category 1 or under category 2. So what under category 1 comes? Category 1 comes under category 1, commercial bank, private and public sector bank, and foreign bank. And in category 2, regional rural banks and commercial cooperative banks. So here, this franchisee may come under category 1 or category 2 or an FMMC to purchase foreign. So foreign franchises perform the functions of RMCs to buy foreign exchange, currency and travel checks in exchange for Indian. Again, the another foreign exchange structure is market maker, consists of market maker. So it is an entity, usually a commercial bank that offers two quotes, bid and offer, in the foreign exchange market and stands ready to buy to sell their specific currency at these rates. Okay, and then just you can see the structure of our foreign market, Foreign Exchange Management Act. This is the structure of Foreign Exchange Management Act. Okay. Central Bank and RBI, that is RBI, authorized person, authorized money changers, authorized dealers, and full-fledged. So this the structure of foreign exchange market, Foreign Exchange Management Act, market in India. Before 1990s, there are more in India with different exchange and instruments. So the Swedish economist Gustav Hassel in 1980, purchasing power parity theory introduced. There, according to this theory, the price levels and the changes in these price levels in different countries determine the exchange rate of these countries' commercial currency. The basic principle of this theory is that the exchange rate between various currencies reflect the purchasing power of these currencies. The theory is based on law of one price. So challenges of foreign markets in India. It is important to look at the growth of the forex market in context with the progress on capital account liberalization, which in turn is driven by wider macroeconomic issues and the changing international climate. The RBI has been aggressively pursuing enhancement of the OTC market infrastructure and devoted to further conformity with the best global practices. Over the counter forex market in India rests mainly with banking industry, and it is the duty of the banks to ensure the appropriate and optimally of the transactions from one point of view to the five. International investments in Indian and emerging offshore markets are also consistent with the ongoing globalizing of the Indian economy. And the structure is also making an emerging offshore markets are persistent. The Indian economy and the efforts should be made to attract all participant investors who are seeking to hedge underlying exposures on shore. So this is about all about foreign exchange markets in India and their challenges. The next topic will be derivative market. Thank you. So the risk is also involved in foreign exchange. Exposure to exchange rate movements. Any sale or purchase of foreign currency entails foreign exchange gain. Foreign exchange transactions also affect the net asset or net liability position of buyer and seller. So carry net assets or net liability position in any currency used to exchange rate.